Hello, and welcome to our Market Alert video for today, which is August 5th, 2024. And this is a special Market Alert video because of the fact that the market has been behaving very crazily. And we wanted to get this video out to you to hopefully give you some perspective from our point of view. So before I go further, I am Ken Moraif. I'm the CEO and founder of Retirement Planners of America. And our singular goal is to create as many squippers as we possibly can. And for those of you who watch these videos, you know that SQUIPPERS is the acronym for Second Childhood Without Parental Supervision. So we want our clients to go play, have fun, enjoy. So when they retire, we call them a SQUIPPER. Now, you can't enjoy your second childhood if you see your investments falling like a stone and you're losing tons of money and you don't have enough money to retire on or to stay retired once you have done so. So in our firm, we have a strategy called Invest and Protect, and I want to get into that in just a minute with you. But before we get into what to do about what's going on, I want to kind of explain, if you will, from our perspective, what's driving this, what's going on. Well, there are several things. One is, as we've chronicled for you in these videos, the economy in general has been slowing down with inflation and these high interest rates because 70% of our economy is the consumer. And with high inflation and high interest rates, the consumer is finding it difficult to spend. So that has been making the economy slow down. And over the last few weeks, we've seen that deceleration actually, the momentum is increasing. And so that was very worrisome. But the good news was that the employment numbers were holding strong. People were not losing their jobs. We're creating all kinds of new jobs. And that was all okay then, because as long as people have jobs, yeah, inflation, yeah, interest rates, but they have jobs, that'll hold everything up. Well, the data we got last week with regard to jobs was terrible. And so that kind of put the pin in that balloon, and it made everybody start thinking, wow, if employment is no longer going to hold things up, what are we left with? And the consumer has spent all of the money, pretty much, according to studies, that they got from the pandemic, where the government threw trillions of dollars at us to help us get through it. Well, those dollars seem to be all spent right now. So there's little emergency fund, if you will, to help buoy the consumer. Jobs are coming down, so that scared the bejeebers out of everybody, and a good deal of the reason for today is what you're seeing. Now, the other part of this is something else is going on, which has affected the global economy, and that is the carry trade. And if you're not familiar with what that is, and particularly Japan. So Japan had very, very low interest rates. And so you could borrow money in Japan and carry that money over to the US and other places where interest rates were higher and lend it there. So you borrow at a low rate, you lend it at a higher rate, rinse and repeat, and you make lots of money doing it. The carry trade works great until it doesn't. So what has happened to change that? Well, the Japanese central bank is now raising interest rates. And our central bank is the thought now is they're going to be lowering interest rates. So now what's going to happen is you're borrowing at a higher rate and you're lending at a lower rate. That's not good. And so the whole carry trade is getting unwound. And these are hundreds of billions of dollars in loans across the globe. And as those unwind, people have to come up with cash to pay for that. And that creates all kinds of turmoil and potentially bankruptcies and all that other stuff. So that thought right there of the global economy being affected by this is also scaring people. So net, you get what's happened over the last 3 trading days, right? So the question is, what do we do about it? Well, at our firm, what we do, and we're probably different than many because we believe that you should buy, you should hold, but you should also sell. So we have a strategy to sell, which we call invest and protect. And we think that if you are over 50, if you are retired or retiring soon, your philosophy should be growth is important, but protection of principal is even more important. And you should have a strategy to protect your principal. And we do. So our strategy has not told us it's time to sell yet. And in fact, in October of 2023, many of you may recall, if you're watching our videos, hopefully you were, that from July of that year till October, the market went down significantly. It was a big sell-off, and our strategy did not say to sell. It said to hold strong, stay in. And we did. And sure enough, it turned around. So we're not ready to say that it's time to sell yet. But having said that, there may come a time when it is time to sell. Okay, our strategy did say to sell in November of 2007 before the stock market crash of '08. It told us to sell in March of 20, literally the day before the pandemic, and in April of 22 before all this inflation stuff started. So our strategy will tell us, and we have confidence in it when it's time. We're not there yet. The other side of the equation is bonds. And so if you've been watching again our videos, and hopefully you'll watch everyone from now on, in December of last year, we said it was time to buy bonds. We had been out of them for almost a year and a half during the great bond bear market. And so we said it was time to buy because we anticipated that the economy was going to slow, the Fed was going to lower interest rates, and in that environment, longer term bonds do very, very well. And in fact, that's been the case. We've seen over the last 3 months that longer term bonds have done very well. If the Fed actually does start to lower interest rates because we're now in a bad bear market, we're in a bad recession, which if this momentum continues, we may be, then bonds should do very well. So our view of how to deal with this, number one, is have a strategy to protect yourself on the downside from stocks if they go down into a big bad bear. And then secondly, we view longer term bonds as almost one of the better ideas right now to take advantage of the fact that the Fed most likely will lower interest rates, and also that if we go into recession, they will be forced to lower interest rates even more. Now, there is precedence for all of this. If you go back to the early 80s, Paul Volcker was the Federal Reserve chairman at the time. And we had very, very high inflation, hyperinflation. And he raised interest rates almost to the sky. We had 18% mortgages back then. And he did that to combat inflation. He waited too long to lower interest rates. And so that caused a really bad recession and a stock market crash. And many investors today are concerned that that's going to be what happens now. The Fed has waited too long. The momentum is now in place. Our economy is so big, you can't change direction on a dime. And so we're going to be headed in and it's intractable. And that, again, is feeding into this fear. It could be right. Our view is you prepare for the worst and you hope for the best. You don't hope for the best and don't prepare at all. Okay, that's not our strategy. You don't just buy and hold. You buy, hold, and you sell. And we are not there yet, but we could be. So I hope this gives you perspective on where we sit right now. We're still not ready, as I said, to sell our stocks, but we definitely are very bullish on longer term bonds. Now, if you'd like to visit with us, please do. Our website is rpoa.com. If you're over 50, we'll visit with you at no charge or obligation. If we can help you, great. And if not, that's fine too. We'll part friends. Okay, so thanks for watching this video. Please share it with your friends, your family, anybody that's scared right now, that's worried. We want to help to alleviate that for them if we can. So again, thanks for watching, and we'll talk soon.